Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide. Here is Nathan Weaver.
Greetings and welcome to Kingdom's Wealth and Wisdom. I'm Nathan Weaver, founder and executive director of Petra Worldwide. When we look at legacy building, shifting assets down the family tree is just a natural step of progression. However, as your estate begins to grow and scale, you will encounter strict regulatory governing your minor's income. Too often, a lot of the wealth builders that come into our office, they assume that moving investments directly into their children's names will automatically lower their tax bracket to zero. But here's what true kingdom leaders understand, that financial planning must be the ultimate foundation for asset protection. So today we're going to discuss the operational bottlenecks you could encounter with the federal Kiddie tax and why putting investments in your child's name is a highly tricky maneuver. So here's how this normally plays out. One of the most common pitfalls that growing families fall into is the thought of being in the lowest tax bracket when it comes to protecting the growth of these assets. Parents will accumulate stock portfolios or mutual funds and then default to opening a custodial account in their minor child's name. They assume these investments will compound at the lowest baseline tax rate. And that's just simply not true because of two things. First one is the moment an asset generates meaningful returns, the tax code aggressively forces that income to be taxed at the parent's marginal tax rate, at the parent's highest marginal tax rates in some cases. And then you also have the loss of control to consider because under a standard custodial account, when a child reaches adulthood, the legal right to the asset shifts entirely to them, leaving that exposed to that young adult's decisions and habits.
Pastors and financial leaders, do you need expert accounting or tax help? Do you have payroll or 1099 questions? Do you need a ministry expert to help you acquire real estate for your next project? If the answer is yes, yes, and yes, visit petraworldwide.org. Petra Worldwide has been strengthening ministries to transform humanity since 2007. Visit petraworldwide.org or call 855-481-9095.
So, what is one to do? Well, I'm glad you asked. Here's what one is to do. To eliminate these risks, your planning must include an understanding of the Kiddie tax thresholds. The IRS enforces these rules on any unearned income. That means interest, dividends, capital gains generated by a dependent child. In the current tax year, it unfolds in three ways. You've got the tax-free buffer. That's on the first $1,350 of unearned income. That's completely wiped out by the standard deduction and becomes tax-free. The second level is the next $1,350 of unearned income. That is taxed at the child's lowest marginal rate, which is typically going to be the 10% base rate. Now, once you cross the threshold of unearned income for a child that's greater than $2,700, every dollar above $2,700 is forced on Form 8615 to be taxed at the parent's top marginal tax rate, which could be as high as 37%. So while the baseline custodial accounts will hit this brick wall, true masterclass planning completely bypasses this kitty tax trap with some proactive engineering. The kitty tax applies strictly to unearned income. If your child actively works in your family business, performing legitimate, age appropriate operational tasks, the company pays the child a legitimate wage. The earned income can independently and immediately be routed into a custodial Roth IRA. You can fund that portal directly up to the statutory limits, allowing that money to be invested and compound at zero tax.
Listen every day at 4 p.m. for Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide, strengthening ministries to transform humanity. On the web at petraworldwide.org.